Welcome to the deep dive. Today, we're getting a grip on a really key tool for anyone watching the Nifty 50.
That's right. We're talking about the Relative Strength Index, the RSI.
Exactly, the RSI.
Yeah.
Think of it as, well, maybe like a speedometer for the market. It tells you how fast prices are changing.
Yeah, speed and momentum. And crucially, whether things are maybe getting a bit overheated or maybe oversold, it helps spot potential extremes.
Okay, so it runs on a scale, right? 0 to 100.
Yep, 0 to 100. The key levels most people watch are 70 and 30, above 70. That often suggests the Nifty might be overbought, getting crowded.
Meaning it might be due for a pullback, little downward move.
Potentially, yes. And below 30 is the flip side, oversold. Could mean it's fallen too fast and might be ready for a bounce.
And the middle zone, say 40 to 60.
That's generally seen as neutral territory, no strong signal either way, maybe just confirming the current trend.
Got it. So for this deep dive, we're actually going to walk through how it's calculated step by step. We'll use some simple hypothetical Nifty prices.
Right, a numerical example. We'll use the common 14-day period for our calculation, just to show you how it works under the hood.
And the goal here is to see how RSI can help you, maybe confirm if a trend is solid, spot potential reversals, or even avoid jumping in at a really bad time.
Precisely. So the first step, step one, is just looking at the price changes each day.
Okay, so if we have, say, 14 days of Nifty closing prices.
You just calculate the difference from one day's close to the next. Did it go up? That's a gain. Did it go down? That's a loss.
Simple enough. We need those gains and losses for days 2 through 14 to have 13 changes over the 14 days.
Exactly. You list them all out.
Yeah.
Now, step two. You need the average gain and the average loss over that 14-day period.
Right. So in our hypothetical example, let's imagine all the gains added up to, say, 750 points over those 13 changes.
Okay, 750 total gain. And let's say the total losses, ignoring the minus sign, added up to 300 points.
So to get the average gain, you divide that 750 by the number of up days.
Well, technically, for the standard calculation, you divide the total gain 750 by the period length, which is 14. Same for the loss. Total loss, 300 divided by 14.
Ah, okay. So 750 divided by 14 gives an average gain of roughly 53.57.
Correct. And 300 divided by 14 gives an average loss of about 21.43.
Got it. Average gain, average loss over 14 days. What's step 3?
Step 3 is calculating the relative strength, the RS. This is pretty straightforward. It's just the average gain divided by the average loss.
So 53.57 divided by 21.43, that comes out to around 2.50.
Exactly, about 2.5. Now we have the RS, we can finally calculate the RSI itself. That's step 4.
And there's a specific formula for this.
Yep, the formula is 100 minus 100 divided by 1 plus RS.
Okay, let's plug in our RS of 2.5. So 1 plus 2.5 is 3.5. Then 100 divided by 3.5 is about 28.57.
Right. And finally, 100 minus that 28.57 gives you?
71.43. That's our RSI for day 14.
Perfect. And remember what we said about the 70 level?
Yeah, 71.43 is above 70. So that suggests the Nifty in this little example might be overbought, hints at a possible cool down.
Exactly. But the market doesn't stop there. What about day 15? How does the RSI update?
Ah, good question. Does it just recalculate using the last 14 days again?
Not quite. For subsequent days, we use a smoothing technique. It makes the RSI less choppy. We use the previous day's average gain and loss to calculate the new ones.
Okay, smoothing. How does that work?
There are formulas. Basically, the new smooth average gain depends mostly on the previous average gain, but it's slightly adjusted by the current day's gain. Same logic for the smoothed average loss.
So let's say on day 15, the Nifty closes down 100 points.
Yeah.
So gain is 0, loss is 100.
Right. You plug that day 15 loss and the previous averages from day 14 into the smoothing formulas. Let's say that gives us a new smooth average gain of around 49.74.
And a new smoothed average loss of about 27.04. The loss average went up because of that down day.
Precisely. Now you recalculate RS with these new smoothed averages. 49.74 divided by 27.04 is about 1.84.
Okay, RS is lower. And the new RSI for day 15 using the formula, 100, 100, 1 plus 1.84, comes out to roughly 64.79.
Right. So the RSI dropped from over 71 to under 65. It's out of the overbought zone, but still above 50.
What does that tell us?
It suggests the upward momentum is weakening, but the uptrend might still be technically intact. It's not a screaming sell signal, more like a yellow light. Caution.
Okay, that makes sense. So putting it all together, how should you actually use these RSI signals when trading the Nifty?
Well, the most common way is identifying those potential overbought 70 and oversold 30 conditions, like we saw on day 14. Over 70 might make you cautious about new buys, or maybe look for shorts if other things line up.
And below 30 might signal a potential buying opportunity or a place to cover shorts.
Generally, yes, but again, context matters. In strong trends, RSI can stay extreme for a while. Also, look at the range the RSI is trading in.
You mean like staying mostly between 50 and 70?
Exactly. If RSI is consistently staying above 50, maybe oscillating between 50 and 70, that often helps confirm an ongoing uptrend.
And bouncing between 30 and 50 might suggest a downtrend is in play.
That's a common interpretation, yes. Another powerful technique is looking for divergences.
Divergences, what's that?
That's when the price makes a new high, but the RSI fails to make a new high. It makes a lower high. That's bearish divergence.
So like Nifty hits 22,600, a new record, but the RSI peak is lower than the last time Nifty rallied.
Precisely. That divergence suggests the momentum behind the new price high isn't as strong. It can be an early warning sign that the trend might be tiring. There's bullish divergence too, the opposite at lows.
Interesting. So RSI seems useful, but it sounds like you shouldn't rely on it alone.
Absolutely not. It's just one indicator. It works best when you combine it with other tools.
Like what? Moving averages, chart patterns?
Yes, moving averages, support and resistance levels, trend lines, maybe even something like parabolics are. If RSI hits 70 and the Nifty is right at a known resistance level, that's a stronger signal.
So on our day 14 example, with RSI at 71.43, if Nifty was also hitting resistance around, say, 22,550, you might feel more confident considering a short trade.
Exactly, or at least tightening your stops if you're long. Confirmation is key. For day 15, with RSI at 64.79, maybe you just stay neutral or wait for a clearer signal.
Makes sense. Any quick tips for beginners using RSI?
Sure. First, don't panic about the math. Your charting software calculates RSI automatically. Just find it in the indicators list.
Good point. What else?
Definitely practice on a demo account first. Get a feel for how RSI behaves on nifty charts without risking real money.
Always good advice.
And manage your risk, seriously. Only risk a small percentage of your capital, like 1–2% on any single trade. RSI signals aren't foolproof.
Right. Avoid overtrading based just on RSI wiggles.
Yeah, and backtest. Look at historical Nifty charts. See how RSI worked or didn't work during past trends, corrections, and crashes. Learn its personality.
Okay, so to wrap up, RSI is a momentum oscillator, really helpful for spotting potentially overbought or oversold levels in the Nifty.
And for gauging the strength of a trend or looking for those divergences, it helps understand the force behind the price moves.
We focused on daily charts, but you can apply it to intraday charts too, like 5-minute or 15-minute Nifty charts.
You can, yes. Just be aware things move much faster on shorter time frames. The signals will come quicker and there might be more noise.
So it requires quicker decision making.
Definitely. Which leads us to a final thought for you to consider. If RSI does flash a potential reversal signal, say, it drops below 70 after being high, or pops above 30 after being low, what else should you look for?
What other factors beyond the RSI number itself could help you decide if that signal is worth trading on the Nifty?
Think about things like trading volume on that reversal day, specific chart patterns forming, or maybe even significant news events hitting the market. What else adds conviction to that RSI signal? Something to mull over.